Everybody, this is Cody Kessler, and welcome to this week's episode of KLA Now. We are coming to you live from the Rockville, Maryland office of Kessler Lending Advisors, a division of HomeBridge, and we're excited to bring today's show. We're actually kicking off a series this week where we're going to start talking about loan products. I'm not a real big guy about actually talking about loan products because I think that most mortgage companies, that's really all that they have. This show, if you've watched any of our shows in the past, this show is really designed to actually give you some inside information, mortgage industry information, real estate information, just really industry specific that is really designed to protect the client, give you some information that a lot of people aren't talking about, strategies. Sometimes we talk about real estate agents, what have you. So, this show is really designed to give you information that you're not looking for. But in today's segment, and the show that we're going to be kicking off, we'll do this once a month where we're actually going to start breaking down loan products and why they're useful. So last week's show, we were actually on location with a realtor named Mark Fitzpatrick, and we were talking about a property that needed renovations. So the first thing I want to do is time to talk about what is a renovation loan, okay? Renovation loans, they are a very well-known product, but they actually have a bad reputation. And that's not because they're a bad product. It's because the bank that's generally doing these loans really doesn't have a good logistical process. A renovation loan is just like any other loan, processed, underwrite the same way, and oftentimes have very similar guidelines. But what you have is you're putting in a contractor, you're putting in a consultant, and we can talk about what a consultant is in a different episode, but you're putting in third parties that if it's not controlled the right way, the process actually can become more difficult. Renovation loans really become difficult not while you're getting the loan, it's actually after the loan closes and you start doing the construction work. So when a bank understands these things, it can help you as the consumer navigate those waters. Actually, renovation loans become a great product that allows the market to open up to you. What do I mean by that? If you're sitting in a market that has short inventory, okay? So a lot like Montgomery County, a lot of parts of the United States right now have an inventory shortage, meaning that there's not a lot of properties that are turnkey, meaning that you're not just walking into a house, it's perfect location, perfect yard, everything on the inside is exactly how you want it. Actually, there's a large percentage of homes right now, resale homes, not brand new homes, that really need to be updated. That if you see the property, you can walk in and if you have a little bit of vision, you can see that if you knock the wall down or potentially renovated the kitchen or the bathrooms or expanded on a bedroom, that it would take that house that normally wouldn't be perfect and you can actually make it your own. So that's what I mean by opening up the marketing and expanding inventory. And if you're working with an experienced real estate agent that understands this, they can actually show you these properties and teach you how to look with a vision. So that's what we did last show with Mark Fitzpatrick's property. It showed great, but with a little bit of vision, that property turned into something that could have been absolutely great. So there's the explanation. So we're going to kind of start to get into what these differences are because there's a couple different types of renovation products. The first one I'd like to talk about is an FHA loan, okay? So there's an FHA 203K. This is the most popular and well-known renovation loan, also the one that has the worst reputation. And as I said earlier, it's not because the product itself is bad, it's because the bank isn't processing it logistically the right way. So first, let's talk about what the 203K can be used for. It can be used to buy or purchase a home, and it can be also used for refinancing your current one. So if you've bought a home and you're sitting there saying, God, I would love to update this, you can refinance your loan into a 203K and get the funds to do the renovation. It's a 30-year fixed standard loan. You can do a ARM. You can do any type of mortgage product that a regular 203B can do. So a regular 203 mortgage. But the one caveat is this product is for owner-occupied properties only, okay? So you have to live in the property. You can't do a second home or an investment. FHA is well known to have expanded guidelines where you can have lower credit scores, higher debt to income ratios, and much more lenient guidelines than a conventional product or a standard renovation loan. Credit scores can actually go all the way down to 580, okay? That's pretty low. A lot of conventional products, renovation-wise, stop at around 680. We can talk about that later. But with FHA, you do have the ability to go down to lower credit scores. You will trade off, because it's a well-known fact with FHA, it only requires 3.5% down. If you have a lower credit score and you're looking to do a renovation or a 203K, it may require that you put a larger down payment, such as 5 or 10% down rather than the 3.5% minimum. So keep that in mind. You can also do these things where a lot of people miss. They look at a lower cost home, such as, let's just say, a $300,000 home, but they want to do a large renovation on that, a $300,000 renovation. You can actually take the acquisition and renovation costs all the way up to the county loan limits. You can find out what those county loan limits are. We'll put that actually a website link in the comment section here so that you can go and check what county and what state and what your actual loan limits are. One of the things that I would want to bring up, as I just said, you can buy a home, and with this actual program, you can tear that house down if it's not livable. Let's just say that you are, the house is covered in mold, it's not in a livable condition, so you can't get a certificate of occupancy, okay, a COO. This means that you can actually do renovations on the home, you just can't move into it. So you'd be able to tear that house down, rebuild it, but once you can actually get a certificate of occupancy, you can actually move in. This product actually allows for you to, in this certain situation, you can finance a certain specific amount of your mortgage payments and roll that into the loan as part of the renovation cost so that you can live somewhere else while you're actually renovating the home. So it's a great option for somebody that doesn't have the ability to say, hey, listen, I don't have anywhere to live, or I can't live in the home because I'm doing such extensive renovations. So that really covers the FHA 203K to a degree, but you've got two different types of K loans. You've got a streamline and then a full K loan. So the streamline is really for the smaller projects, cosmetic projects. A lot of times when you move into a house, it doesn't need to be fully renovated. It just needs to be updated. Things like updating, the carpets, the floors, the walls, paint, things like that. And the project has to stay under $35,000. If it is, it's called a streamline. And what that means is really you're getting two draws. You're going to get 50% of the project at closing and then another 50% when the project is done. Let's talk about that in comparison to the full, okay? The full is where you are doing a large project. There's really no limitations as long as I said it stays under the county loan limits. So you could do a $100,000 purchase, and in Montgomery County here, you could do a $500,000 project as long as the total loan stays under the county loan limits. But a K loan is much more like a traditional renovation project where you're going to have phases. And it can be as many phases as needed in order to complete the project. So you could have 5 phases, and each time you're going to draw out on that. This is where you'll have that consultant. I mentioned that earlier on. This is a third-party person that is hired in order to protect you as the consumer and to make sure that the contractor is doing that project to the scope of work. They are the ones that go out every time and make sure that the project is being done correctly, that the project is done to the quality that the bank and you as the consumer are expecting before the bank releases that next phase of money. So it's a great way to make sure that you're protected, because there's a lot of people out there that don't know good contractors, certainly don't know how to check the work, and would end up getting in a bad spot. So that consultant, while it does cost an extra $1,000, sometimes it's going to save you a whole lot more. So it's not a con, it is definitely a pro. So the streamlines, again, $35,000 the full, you can do whatever you want, and those don't have really any type of limitations in regards to the project when you're rebuilding. Okay, so let's go on to the next type of renovation loan. This is a conventional renovation loan, a Fannie Mae home style. This one really doesn't have any type of limitations, meaning that the FHA 203K, you can't really do luxury items. The home style, you can do whatever you would like in that property as long as it's affixed to the property, okay? So these are conventional loans. And up here, they really do say that it's a 417 max, but it does go to your county loan limits if you have a lender that will do so. A lot of the lenders that work with the home style stop at 417. They won't do the high balance, okay? So you need to check with what lender you're working with in order to make sure. The standard down payment with this, just like a conventional or a standard conventional, is 5%. Okay? You do have conventional products that will go above 5%, or excuse me, meaning that they're 97% LTV, but with the home style, it is a 5% down payment minimum. Okay? You also have to have a FICO of 680. Now again, this is not necessarily because the Fannie Mae delineates this. It's more that you're not able to get mortgage insurance with a credit score below 680 and it make any sense. 680 is where you start to look back and forth between, do I go home style or do I go with a 203K? So you should be working with a lender that's going to help you analyze this and come to a good, solid conclusion as to which one of these programs is going to work best for you. You've got, the ability to do things, you can do landscaping, you can do the luxury items with this one, like you can actually add a pool. The 203K, as in a comparison, you can repair a pool if it's existing, but you can't put a brand new one in. With the home style, you can actually design a beautiful backyard with, a patio with stonework, landscaping, and a brand new pool, and you can actually finance that into the loan. So it's a great product if that's what you're looking to do. One of the greatest things about the home style, one of the biggest differences, you can actually use the home style product to renovate a second home or an investment property. And yes, if you are an investor out there, we are talking to you because you can use this property. A lot of investors use hard money in order to purchase homes and rehab them, and they flip them. If you're not flipping, if this is a buy and hold for you, this is a great option because it only requires 20% down on the project if you're an investor. So it's fantastic. So if you're a real estate agent listening to this as well, remember, this can open up a ton of market. There's a ton of people that are talking about investing right now because property is a great long-term investment. So if you're looking for buy and holds, this is where you want to look because there's a ton of property out there that you need to fix up in order to rent it out. And this way you're keeping your principal cash or your capital investment into these properties low, meaning that you can do more than one project at a time. So keep that in mind. It's a great tip there for this project. I got one more to talk about. We've got a HomeBridge Home Fixer. Now this product is proprietary to HomeBridge. This is a little bit more interesting because it's not an actual loan. This is more an escrow repair. Now if you go back 10 years, escrow repairs used to be pretty common. Something would come up in the home inspection, it would cause an issue, and then really what you would do is you say, okay, well we're going to hold this amount of money in escrow at closing, and then we'll do the repairs after closing. Lenders didn't care. But now it's a different world. Lenders do care. And actually most lenders and the investors, Fannie Mae, Ginnie Mae, and Freddie Mac, they don't want an investor to close a loan until it's actually met the criteria, meaning that it has to be in the condition so the appraisal can be done and the property can be considered lendable. So what do you do in that situation? And I like to use the example of a short sale. So the seller is selling their property, and they're obviously selling it short, meaning that they're paying the bank less than what is owed because the value of the property is not there. So if the bank's agreeing to take less money and the seller has shown that they don't have the ability to pay that off, you're walking into a situation where you don't have a lot of negotiation power. So I'll give you an example. The buyer does a home inspection, and the home inspection shows that the property needs a brand new HVAC, okay? And there's some plumbing issues. Generally speaking, that's going to kill your deal. Why? The bank's not going to agree to do any repairs to that property. The seller doesn't have any cash in order to repair those items before closing, and the buyer is not going to put any money to fix items into a house that they don't own, obviously before the loan is closed. This program fixes that problem because what we do here, we'll take the HVAC. We go out and we get a bid from a contractor to repair the HVAC. We can do things up to $5,000 for repairs. So let's just call it $5,000 in this situation. The buyer or the seller can credit an escrow account that we will hold. We will close the loan and repair that HVAC within 14 days of closing the loan. This allows everybody to be protected. The sellers don't have to come out of pocket. The buyers don't have to come out of pocket until after they own the property. And then we as the lender know that the property is going to be repaired the right way, fast enough so that we can close that loan, and then we can securitize it with one of the GSEs. A lender that is not a mortgage bank is not going to be able to do this product, and this is something that I said, I don't know of any other bank that's doing this, so it is a fantastic way to save those deals. If you're in that situation right now, make sure that you're either contacting us to ask questions about it, or if you're an agent and you've seen this, call us to talk about this. This is a great way to make sure that you do not kill a deal that could get to the closing table. A lot of people ask us the question, can I do these repairs for renovation loans myself? It's oftentimes that somebody's a handyman, and they think that they can do these things. So one of the downsides of this is you cannot do these repairs yourself. You have to have a general contractor that is licensed, bonded, and insured to do the work. They do also what you want to make sure that they're familiar with these types of loans. If they're not, you should want to make sure, and you might second guess working with them, because it really does make a big difference if they're familiar working with the product. So let me get back to the question of, can I do it myself? You can do certain parts of the job. You can't do the whole job yourself. And I'll give you an example. If you are a plumber and you have plumbing work that needs to be done yourself, as long as you're a licensed plumber, you can perform that piece of work. You can do the plumbing job. You cannot charge for labor when you yourself are doing the work. You can charge for parts, and that can be a part of it, but you won't be able to include paying yourself. So that would be part and the only way that you can do it for yourself, and so hopefully that answers that question. That is a big one that we get all the time. But if there are any other questions, that's really what I've got for you today, but feel free to reach out to us. You can always contact us. There's a couple ways to get a hold of us. If you got questions on this, email us at KesslerLendingAdvisors@homebridge.com. You can call us here in the office at 240-403-7233, or you can always hit us here up on Facebook or reach us out at Instagram. So guys, thanks for watching. Hopefully you found this interesting and useful. So please share the information, like us here on Facebook, check us out on Instagram. I'll leave you with one thing. If you're a listing agent watching us, contact us today to find out our new listing spotlight. It's a great way to get free marketing for all of your listings. Thanks so much for watching. We look forward to seeing you next time on KLA Now.